So, good morning and welcome to another episode of the Upside Podcast. Today we have Hasan Haider. Is it Haider? Haider of Plus
Higher,
VC.
higher.
Haider of Plus VC, a pre-seed and seed VC focused on the MENA region. So, prior to setting up Plus, he was the managing partner for MENA at 500 Startups and has been angel investing in the Middle East for more than a decade. He joins us from Bahrain. Good morning, Hasan.
Good morning.
Thank you for joining us today.
Yeah, pleasure to be here.
So maybe if you could kind of take us right from the very beginning. I mean, you've been investing for a long time. Plus, it's been around for a couple years now.
Yeah,
Maybe if you could, how did you get started in your investing journey, and how do you, if you could kind of, share like how the last 10 years have been in terms of seed investing and how that has evolved through time or in a lead up to Plus today.
sure. I guess I started this journey about 15 years ago, so it's been quite a while.
Mm,
It started maybe a bit before that. So I worked in an investment company in asset management, listed equities, like trading stocks and stuff. It was a great organization, but I didn't feel fulfilled. Like I was moving numbers on an Excel sheet, but nothing really I did was having any real impact in the real world, right? Like it wasn't really meaningful. So I decided to do my own startup, and it was like an online DVD rental business. We'd send people physically the DVDs and pick them up. This was 2007. So when Netflix was still doing this, it wasn't streaming yet. And then
mm,
I set that up, was doing that part time, but I really had no idea what I was doing. I wasn't really understanding a lot of really the core aspects of setting up a startup. But one of the things I did was I started reading about how startups were getting funded. So I started reading about angel investment, venture capital,
mm,
and all of that. So I like to read, and that was really interesting. So I was like, wait, let me go out and get some angel investors for this. I was not successful. That company shut down, but
Which year was this?
this is 2008, 2009-ish.
Okay. Wow.
I made a lot of mistakes. I did all the things you shouldn't do as a founder, spent in stupid places, like it did everything. So now I know I can advise people what not to do because I did the things they shouldn't do because, that's kind of the thing. And, um,
Can
and
you
then
share? Like what did you do? Uh
there's a
ex
list. It's like, everything that they advise you not to do, I did. So, it's okay. It's fine. Like, but generally what happened is I started to get more into this whole the funding of the companies thing.
mm,
And in one of the meetings that I had with some of the business families here in Bahrain, with Mr. Sami Jalal, he's the one of the board members at Mohammed Jalal and Sons here, one of the big families. He's like, look, I'm not going to invest in you, but let me give you some advice. I was like, okay, well, I need money, but I'll take the advice. And but it was great advice. It was like really like eye opening. I was like, well, if I had this advice at the beginning,
mm,
things would have been very different. And so that he became like my mentor and continued to advise me. And then at one point in one of the meetings he was having with me, he's like, what's missing? Why aren't you able to scale and grow this business? I was like, well, we don't have angel investors here in the region. And he's like, what's angel investing? And I told him it's people like you provide guidance, advice, a network, but also will invest in companies. He's like, well, you know what? Let's do that. And I was like, what? Okay, well, let's do that. Let's figure that out. So then, with him being the champion and leading this, we went to his network and we got the
mm.
support of the government and a bunch of people, and we set up 10 more. And it was essentially one of the first angel investment organizations in the region in 2010. Case study at the World Bank. Babson did a case study. It was really cool. Like it was one of the early days of the whole ecosystem getting started. And then fast forward, I was like, well, we're seeing all this deal flow from around the region, but our mandate is only Bahrain idea stage. I want to do a bit more. And then I was like, well, I want to do this venture capital thing. And all the investors that were in the angel group were like, we didn't know anything about angel investment until you came to us. We don't know anything about venture capital. You go and figure it out.
Wow.
Um, so I did this. I did a Disneyland tour of Silicon Valley, where it's like, let me go to Silicon Valley and see what this venture capital thing is. Met with a bunch of funds, and this was like 2000, I guess 13, 14 was the trip. And
What was the reception like? I mean, like to them, you're like, "Where's Bahrain?" You know, like, "Why are you here?" They must have thought. I'm assuming they must have thought that.
no, it was hilarious. Like I would go into meetings with partners. Well, I got good meetings with funds that were like, we're a global venture capital fund, and like in one of the meetings, the partner basically is like, I was talking to him, and he's like, "Oh, wait, just give me a second." He pulls up Google Maps of the world on the screen, and he's like, "Can you point to where in the world you're talking about?"
Oh
And I
my
was like,
goodness.
well, this meeting's not gonna go well. And so no one really knew in 2013, 14 anything about the Middle East. They didn't care in Silicon Valley, anything outside the 2 hour radius of where their office is, they weren't really interested in. But one firm was, and so I met with the founder of 500 Startups at the time. 500 had already been looking at the region, had done a trip already to the region, uh, had been active and done a few deals, and then built that relationship. And at one point, we were like, why don't we just do this thing together? So I ended up joining 500 Startups to launch the Middle East North Africa operations, built out the team here, built out the brand.
And what year was that?
I joined end of 2014, then started working on the fund then started working on a dedicated fund for the region in 2015, and
Mm.
then managed to get a first closing done in 17, and the rest was pretty cool. So built out a pretty awesome brand here in the region, built out an amazing team that was there, and did 181 investments. So we were the most active fund in the region from 2017 to 2020. And then obviously there were a lot of changes at 500. It even renamed from 500 Startups to 500 Global, so it's not quite the same organization that I was at.
Yeah.
And so I ended up leaving to once we finished all those investments out of the Falcons Fund, it was called. We
So
ended up.
the Falcons Fund, was it already a separate fund in the Middle East under 500
Yeah, it
startup?
was. So it was a. I set up and raised a $33 million vehicle called 500 Falcons, which was entirely operated by me and the team here in the region. So
Mhm.
we out of that is where we invested 181 deals in the region. So yeah, it was pretty cool.
Yeah.
Yeah.
I mean, globally, I mean, we've seen quite a number of spin-off funds. I guess yours is one of them. Even in Asia and even parts of Europe, I believe, like there were a lot of spin-off funds where the partners that were the country heads of their regions eventually just kind of started doing their own thing. I mean, how was your experience like at 500? I mean, I know it started off well, but I think for a lot of people, it started getting a little bit chaotic and messy, and everyone decided it would just be more advantageous to just do their own thing, which eventually led you to starting Plus, right?
Yeah, I think most of the fund managers that were there, there was a period where there was an expansion where 500 wanted to have a lot of funds all around the world and found great managers and great people to run those. And the way that was, it was more a loose federation. Like, here, use the 500 name, but go raise your own fund, do your own deals, do whatever you need in your region to make that thing successful.
Mm.
And then things started to change. Things at 500 were different. And so we decided, me and a lot of other fund managers decided, well, thank you, but now it's time for us to go out and do things for ourselves. And so yeah, that's what
Did it
happened.
have anything to do with incentives or just a matter of being able to move more quickly and be more nimble as an independent operator?
I think there are a variety of reasons, and everyone had probably a different reason for leaving. For us, it was just probably just alignment with the core versus what we wanted to do in the region was a little different. We wanted to do more. I mean, our focus is my focus is always I want to be the best investor wherever I am. I want to invest in the best deals. Anything that
Mm.
distracts from that focus of investing in the best deals for me, I was like, I really don't want to spend time doing that. And so I think that's where things started to change.
And did you have any kind of anxiety around, you no longer being part of the 500, like a global brand and having that kind of name and now setting things up for yourself as, an emerging GP? How is that experience like? Because I feel like in the Middle East, well, I mean, I guess it's very similar globally, right? Like, being part of a bigger brand is always very advantageous to a lot of people. You tell people you're Sequoia, like, boom, all the deal flow comes to you. No matter for all the history that, some of these funds have had, but, having the brand name is always a big help for GPs.
Yeah, definitely having the brand name initially was helpful. Saying we're part of a Silicon Valley firm and we're the first Silicon Valley based firm to set up an operation in the region. Like all of that was really, really helpful. But at some point, you realize that essentially 500 didn't have much of a brand in the region, and
Mm,
all like I had put a plan to build a brand and everything in MENA, and I
mm,
executed on that plan, and then it worked. So I was like, well, I did it once, I think I can do it again. So
mm.
now with Plus VC kind of going down, with the learnings of the first time, the same kind of playbook, and thankfully, Plus is now the most active fund in the region in Q1 of 2025. We see almost every deal in the region, and I think it works again. So the core of any brand is the people around it, and I think
Yeah.
a lot of the team moved across with me, and we've been able to rebuild and build a really great brand at Plus as well.
Mm. And what about kind of the angel investing landscape from, say, 10 years ago, till now, from the very time that you started, again, this is more than 10 years ago, to
Yeah,
now, like how would you kind of
15
describe
years
the
now. Yeah,
evolution, the opportunities, the talent that you've seen come through your door, as well as some of the challenges that, you think both investors as well as founders face today? How has that changed?
I think there's been a lot of changes in 15 years. Like when we were first getting started, no one knew it. Like even the really funny thing is when I started, there was no commonly agreed term for entrepreneur in Arabic.
What?
Yeah, the word didn't exist in Arabic. There was businessmen, there was other thing, but entrepreneur specifically wasn't a thing. And there were like competing phrases from Egypt, from the Gulf, and from Lebanon and other markets. And so,
If
the
you're a businessman, you are an entrepreneur,
no,
right?
but in Arabic, businessman has a very specific. It's not it's a very specific sort of meaning, and so there wasn't a meaning for entrepreneur, and so that's basically,
Wow.
that was where we're at. Like in 2010, there was almost nothing that existed, right? And so the people that started in 2010, like me and the guys at Fast Labs and the Angel Group that came after and Cairo Angels, like we were early believers. Like we went in not really like there was no evidence that this thing was going to work at all. But we
Yeah.
went in with the belief that it has to work because everywhere else in the world has these ecosystems and funding markets and whatever. We need these, they're going to be there. And then people are like, oh, there's not enough founders. I was like, no, I'm sure there's enough founders, but there's just no opportunity for them to get funded. So you just don't see
Mm.
them. And so, like, that was the circle. And, like, the universe has changed so significantly that now, entrepreneurship, startups, and tech is one of the key focus areas for most of the governments in the region. When I was talking to governments in 2010, they were ignoring, like, they're like, oh, it was this dinky little thing you're talking about. I was like, yeah, it's dinky now, but it grows. Like, it grows. Like, that's the whole point of startups and VC. But yeah, you gotta be a little crazy to be the early believer and one of the first people to really think about this and give startup founders money and be like, here's some money. Because, like, the thesis before with the business community was like, my money's worth more than you as a founder, so I'll give you the funding that you need. I'll take 90% of the company, you keep 10%. And that's how traditional businesses were kind of run. Like, you keep 20%. That's your sweat
Mm.
equity. I'll put in all the money and then you keep your sweat equity. So changing that around to we as the money, as the minority, and the founders keep the majority because they're the ones that are going to keep this successful. That was a
Yeah,
major like mental shift that has happened like now with a lot of investors. So it's been an interesting journey, honestly.
that is interesting. Um, I mean, in terms of, I mean, just curious again, this must be embedded in some of the cultural understandings of, entrepreneurship in the Middle East. But so when you say businessman, the definition of businessman in Arabic, like what kind of connotation does that have
It's like
culturally?
it's
And
closer to trader, like tajir. It's like
mm,
it's that, not so much as like an entrepreneur sort of thing.
okay,
Yeah.
and what kind of perception hurdles? I mean, did you face in the beginning and even now?
I mean, it's the same
Especially when
thing.
it comes to the idea of, I mean, I guess number one, what does it mean to build, right? And number two, the perception of risk. Because if you don't have an understanding of what it means to be an entrepreneur, you don't understand, you don't have that risk cost, analysis of like how risky is this, what other risks I can bear before this can, gain fruit later on. I don't know whether it's like 5, 10 years. Yeah, how does that play into the minds of builders?
Uh, so I think, honestly speaking, it wasn't a thing that people were looking at. People weren't thinking of setting up startups or companies
Mm,
as their primary objective in life. They were like, historically, it was let me go get a good government job, let me go and work in a private sector company for life, and then that's it. So the career paths for most people in the region were kind of set. Like, oh, I'll go work for the government, I'll go be a doctor, I'll go in the private sector, and I'll get
mm,
a job that will keep me comfortable forever. So there were only like there were people that had that entrepreneurial mindset, and they did. They went out, they built businesses, they built some of their biggest sort of companies in the region um, through like a trading mindset. And they also did fund a lot of their friends and family to build companies and do other things as well. So that was there as part of their culture. Like, let me support this guy. I believe in him. Let me give him some funding to get
mm,
started. So that was all there. But turning it around of being like, look, the founders are the ones that should be getting the majority of the the shares in this deal, and all of that, and like then the second part of it, which is there's this very high risk because we're not buying assets, we're not buying real estate, we're not building a factory, we're not building something tangible, like
mm.
moving into the software field and investing in people that build software that doesn't really exist. That was a whole hurdle that people needed to get over. And so now I think we're kind of mostly over it. We've seen success stories in the region. In Saudi, there's been IPOs like Jais and Hasan, which were like honestly watershed moments. Before that, we had the exit of Talabat, not
Mm.
the IPO, but the first exit.
Yeah.
Actually, it wasn't even the first exit; it was like the third exit. But like the exit of Thalbot being acquired by the team at Rocket and Delivery Hero and whatever.
Mm.
So um, we've had enough successes that it's become a real thing that people are looking at. We had a period of madness, I think, in 21, 22, like the rest of the world, where
Yeah.
kind of there was too much money flowing into this stuff. But I think we've kind of mostly adjusted now to something more realistic in the region in terms of what's happening. We didn't have the massive crash of, 90, 80% of funding drying up, but we did have, a decline in funding. But I think it was healthy. So the universe
How would
looks
you,
better.
yeah, where would you kind of describe MENA in terms of where it is in the down cycle? I mean, the correction happened in 2021. It's
Yeah.
already 2025, so it's been 4 years. I mean, from what I saw in Southeast Asia, it took actually quite a while, much longer than I expected, to be honest. In MENA, I mean, how is the experience like, and where would you say, which part of the down curve are we?
So I think we in MENA we tend to react to global shocks a year later. That's kind of the thing. So things were going wrong in the world. Interest rates went up. Venture capital dried up. Uh, the tourists left the market. But in MENA, things continued to develop for a year, and almost exactly a year later, things in MENA started to dry up as well. And so that's when we had a correction, which is about a year after the rest of the world sort of was having a correction. But the correction wasn't so severe, and I think it was needed. Things were getting a bit ridiculous. Like people were paying valuations for pre-seed startups at like $30 million valuations. It's like we have no history of exits at decacorns for that to make sense, right? Like
Wow.
we're not Silicon Valley, so you need to price things to where the high water mark is or is likely to be in your exit scenario. And 10 billion is not that high water mark. It's maybe a billion, maybe two or three, but not 10. So we were seeing a lot of craziness in terms of pricing and valuation. And I think that's all kind of mostly been fixed. There's still pockets of madness in a few markets, with a few deals, but we're generally seeing things have adjusted. So we're at this sort of stabilization phase.
Mhm.
I think interest rates are going to go down again, but we have, geopolitical situations in the region. So we're kind of probably going to be at around this level, maybe slight growth going forward. I think that's where it's going to.
How big were the corrections across the state? Well, I know you only see like pre-seed seed, but like what kind of corrections did you see? Did you make any kind of markdowns even on your own companies? And I think what we've seen also is that this applies to all the stages, is that the threshold for investment has also gone up significantly.
Yeah.
So for you to even put your first check means that you also have to raise the bar somewhat, right? So founders have to work a lot harder to reach those milestones before they can even earn their first check. How is that all kind of played in the last like year or so? Where do you see that moving forward?
I think what's happened is that at the late stage, definitely there was a massive correction because there's a lot of late stage money coming in from outside the region, flowing
Mm.
from Silicon Valley to the world. And that all dried up once Silicon Valley sort of crashed, right? So markets like Egypt and UAE, a lot of the funding that was coming to them kind of like disappeared at late stage. And we don't have a lot of late stage funding in the region. Series B plus is a gap in the region that needs to be filled a lot more. We don't have a lot of funds that are able to get startups to significant rounds. I don't think a startup can raise a $200 million round in the region very easily. With regional investors. Um, so where I think we saw is, uh, things right up at the late stage quite significantly, and the startups that were doing the grow at all costs, negative unit economics, they were the most impacted because suddenly they have no money and their business model just doesn't work, right? They'll never make money, and so the charity that the VCs were giving them has gone away. So, but the inverse happened is that companies that were really solid, positive unit economics, doing really well, were spending on growth, were able to like figure things out, and they're still growing, but at lower rates. And so we had great companies continue to work and survive and do well and grow even during this period, and still able to raise rounds and stuff. So Flowered and Callow and a bunch of great companies were still able to raise and continue to grow and develop in this period. So you started to see this sort of split between the ones that were honestly shouldn't have been raising and shouldn't have been receiving the amount of money that they have, and the ones that were like, yeah, this is really a solid company no matter how you look at it, and those continue to do really well. And when it comes to seed and pre-seed, I think there was a lot of madness, like I said, in terms of valuations. And I think that all corrected really well. Like we were starting to see average valuations for pre-seed companies in the region. At one point, when Silicon Valley crashed and the MENA hadn't yet, we were seeing pre-seed deals in the MENA region at higher valuations than Silicon Valley. And I was like, this is crazy. Like, there's no way. This doesn't make any sense to me whatsoever. Um,
Wow.
yeah. So like deals in Saudi were at 20-30 million dollars. Silicon Valley deals are like 10, 15 at
Who
that
was
time.
pricing those deals? Was it the VCs or the like family offices or because obviously there mustn't be like when it comes to benchmarking, I mean, someone should have been doing that benchmarking to be able to know, right?
I think the region in general as an asset class, venture capital is very nascent. So a lot of the VCs that have only been around since maybe 21, 22. So they haven't really seen declines. So they were just caught up in the hype. They're like, oh no, things are always going to go up and to the right. So they didn't really adjust well enough, and they didn't have the experience. Like I've been through a few downturns now, so I kind of know what was going to happen. But a lot of people that were just new to the whole investment world, some of them as well. So I think it's just a factor of the nascency of the market, is, and the inexperience really that was in the market at the point. But mostly, hopefully, has adjusted now, and people have learned their lessons. But VCs generally don't learn their lesson, but hopefully they've learned this one.
Well,
Uh,
maybe from the perspective of Plus, like how have you also adjusted your own kind of VC discipline when it comes to valuation or
oh,
even in
we
terms of say exits, right? Because having seen so many cycles, and you're talking about emerging markets, well, obviously there's a lot of volatility, there are a lot of changes. You must have also evolved even your own approach to maintaining discipline on some of these things.
I mean, we've always been pretty disciplined. So there were a lot of deals that were like raising at these valuations, and I was like, "Am I wrong? Like, this doesn't make sense to me. Am I like too old now? Like, is that the new normal? And should I adjust myself?" But I couldn't bring myself to pay those valuations. So we didn't participate in those crazy things. We were just looking for deals that made sense at the right valuations where we felt that given the current structure of the market, where things are going to be in the when we look at when we are likely to exit this deal, is there a good probability for us to exit at a good return, right? So I don't think a lot of investors are looking at it that way. So I've always got this plugged in my brain that like if I pay a 10 million valuation for a deal versus a $5 million valuation at a deal, sure at exit I might make 50x, but I could have made 100x. And like that, like
Yeah.
so I'll make a lot of money, but I could have made double that a lot of money. So
Yeah.
let me do that and not overpay for things. So we're quite price sensitive as a firm, and especially in our market, like we can't afford to price every deal as if it's going to be a unicorn because most deals aren't going to be a unicorn because our ecosystem isn't there yet.
Yeah.
We're like for me, a good exit is at a 200, $300 million valuation, right? I think an exceptional exit is $1 billion. Like I'm not even thinking of anything above $1 billion in terms of exit value for companies that I'm investing in because they're just so rare and the market just doesn't have the funding to get companies to those levels yet. Like we can't. Like it doesn't make sense for us to price deals as if they're gonna be a $5 billion or a $10 billion exit in the region because our ecosystem in the next 5 years is unlikely to be there. Maybe we'll
Mm.
get to high water marks of three, maybe $1 billion, but above that, unless something significant changes in terms of availability of late stage funding, I don't really see it. So that's how I look at things. So we've always been very conservative when it comes to price. We've turned down a lot of deals just because the pricing just didn't work for us. Like it just doesn't make sense. Not for us, not for this ecosystem, and not for the stage that that company is working at. And one of the things that a lot of founders, especially at pre-seed and seed, is they don't think in advance. They're like, they don't think that, hey, I don't really have anything now. I'm going to build the company. I'm going to get to great metrics, and I'm going to raise my Series A. They don't think of what the valuation is going to look like at Series A. So, like, I've had so many of these conversations where, like, okay, you don't have anything now. We believe in you. We think you're a great founder. But, like, okay, we will fund you now. What's
Mm.
going to happen a year from now? What's your company going to be like? Like, oh, we're going to launch a product. We're going to have 100K in MRR. I was like, 100K in MRR? That's amazing. But that's like $1.2 million in ARR. And right now, if you're looking at a SaaS business in the region, you're looking at 8 to 10x multiple of revenues at Series A. So you're kind of gonna be at a maybe a 10 to $15 million valuation at that stage. So tell me why I should pay 18 million right now for that? Like
Mhm.
I don't think that makes sense. And so we've done that exercise with a bunch of founders where we're like, dude, like let's get back to realistic sort of numbers based on where you're gonna be with the funding that's gonna be there. So we haven't really changed that mindset. We've probably adjusted it a bit higher. The market has evolved from where I started, and in 2017 when we started investing out of the Falcons Fund, valuations were probably at $1 to $3 million sort of terms. We're
Mm.
not seeing too many of those deals anymore. Like I think the market's evolved. We're probably seeing on average deals that seed and pre-seeded. They're raising 1 million, maybe at a $4 to $6 million gross money valuation, and that's kind of where the
What
universe.
about in terms of exit strategy? I mean, do you typically take some money off the table at a
Yeah,
Series A plus, or do you prefer to hold for a bit longer? And how do you kind of distribute it across the many companies that you have, right?
sure. Like maybe just to go through the way that we operate as Plus VC. we're in an emerging market investing in a really risky asset class. Everyone just is always thinking risk, risk, risk. Emerging market, risky asset class, seed, pre-seed, so risky. And so for me, I was like, how can I myself be comfortable that I'm gonna make money for my investors, right? So I'm a data driven person, and so I looked at all the numbers. I looked at the data and the probability of distribution of exits and returns and how things are gonna look. And so when we looked at it, it's like 60% of investments at early stages are gonna go to zero.
Mm.
20% are gonna return 1x. So 80% of your deals aren't gonna generate a return. That shouldn't be news for anyone. And then everyone's like, oh, the top 20% will do really well. And so you need 2 out of 10 deals to be successful. I was like, sure, but at what level do they need to be successful? So most people stop there. They're like, oh, well, 2 will do well. I was like, yeah, but how well do they need to do? And so when you break down the top 20% of deals, it's an interesting story because about 10 to 13% of the time you'll generate a 5x return. And a 5x return in any other asset class is phenomenal. But if 2 of your 10 deals are doing 5x and the rest are not doing anything, you're kind of breaking even on a portfolio level. So I was like, well, that's not great. And so when you look at the rest of it, you're like, okay, then like let's look at the outliers. Let's look at the power law, the long tail, the deals that really are what we're doing this VC thing for. And so it turns out if you're looking at a 20x return, those deals happen about 5 to 7% of the time in a market. And if you're looking for a true outlier of a 40x return or more, those only happen about 1 or 2% of the time. So based on that data, we pulled together the way that we operate as Plus VC, which is we're building large diversified portfolios at seed. We're investing early and often, and we're investing in, on average, about 100 to 120 deals per fund. So we're diversifying out the risk quite significantly. And that helps us quite a lot. So we put small checks to work in a lot of companies, and then we play the probability game and we understand in general, when this all pans out, we're gonna generate a return of around 4x, which is a great return for VC in general. So that's kind of how we operate. And that hasn't changed because we don't really need to change because it's kind of been working before. So it's been pretty cool. And in terms of how exits work for us, because of this is the way that we look at things, we're looking at outlier returns being 20x's or 40x's. So if a deal starts to hit 10, close to 20x, and it's still a Series B deal, and I'll start selling. Like I'll exit 20% of my stake. Well, each decision I've learned you have to do, you can't have a blanket exit thesis. You kind of have to look at a deal on a case by case basis. What does the valuation of this round look like? What do we expect the company to be doing in the next year or two? How's their growth been? What does the company look like? And all of that. And then you make a decision or like, yeah, I think this is a fair deal to exit, or like, no, let's be a bit greedy, or let's try to exit as much as possible right now. So each deal is a one-on-one conversation to see what the exit is gonna look like. But one thing that's different here than in Silicon Valley is the secondaries market are really, really active at late stage, at the later stage, let's say, like in Series B plus.
Mm.
Once a deal has reached that level where they're $100-200 million-ish valuation company and the Series B players start to operate, they want to acquire as much ownership as possible and they want to buy out my stake. So I don't really need to wait for IPOs or exits of big companies. I can exit through secondaries. And I think the core difference here versus in the US is secondaries in the US are kind of not something a lot of VCs think about because the SEC exemption allows them only to use 20% of their fund for things like secondaries. In the
Mm.
region, we don't really have those exemptions, and we're not really worried about that stuff. And so a lot of the later stage D funds or even the Series A funds, they're actively buying secondaries because there's no restrictions around those. And so yeah, I can sell secondaries. I can lock in 31x, which I did on one deal in 3 years, or 17x in 4 years. So that works.
There aren't that many secondaries funds or platforms in
It's
MENA
not
right now.
because we don't need those because the
Okay.
actual VC funds themselves don't have restrictions around doing secondaries.
Okay, okay, interesting.
Yeah.
Um, yeah, I wanted to ask you something else. Oh dear, so many questions. Uh, okay, I mean, let's get to one of the questions that I did prepare. I think you may have seen Clearworld's data. one of the things they did say was the number of Series A startups when they compared from this year to vis-a-vis last year has actually remained pretty much flat. And according to their estimates, if this continues, we can expect something like 30% of the number of Series A startups to basically, that's the attrition basically of the Series A startups. I'm wondering if you think that's kind of like the calm before the storm. Are we going to see more attrition on a Series A level for MENA?
No, I think the definitions in the region have started to change, right? So
Mm,
before, like a pre-seed round would be a couple $100,000. Now it can be anywhere from 500,000 to $2 million, right? So that can be a pre-seed, and the seed stage is anywhere from again $500,000 all the way up to maybe a $3-4 million round. So the definitions I think of seed, pre-seed, and stuff are currently evolving in the region because where it was a few years ago versus where it is now, there's the rounds are getting bigger because I think a lot of investors and founders have realized that raising too little capital, a few $100,000, doesn't get them far enough, and
yep.
so you fall into this trap of like constantly raising, constantly having to do a bridge and all of
Mm,
that. So now by raising like secure enough funding to get you to your next round, it makes sense. So the psychology in the region has changed a little bit. Um, but I think it's natural. I think as more and more deals are getting funded at seed and pre-seed, and they're not that much more, but like a few more. And as most of the funds have moved away from seed and pre-seed in the region, and they're more focusing on Series A lot more of those failures are going to happen for sure because honestly speaking, there isn't a clear path to Series B or C unless you're super sexy, amazing sort of company, and you can get like either money from outside the region or one of the banks or someone really
yeah.
cool to fund you. So there is a gap. So there's two gaps. There's gaps at seed and pre-seed. There's not a lot of people that want to do what we do, which is fine. We love doing it, so we're going to continue doing this. A lot of the funds move towards Series A, so there's a lot of funding that's coming there. And then at Series B, there's another gap. So naturally, I think there will be
So
the
slightly uncertain times for Series A startups then. I mean, I guess in some ways it may be a good thing because they'll be pushed to basically hit their profitability targets much earlier than expected.
I think most startups in the region now are looking at how do we get to break even quite early in their career in the life cycle of the startups.
Mm,
At Series A for sure, you're already looking at that. But even
yeah.
at seed, we have startups that are like, well, how can we build this sustainably? And I think that's a nice change that's happened.
Yeah, I think the question that I wanted to ask originally was you did bring up about this issue about power law. I mean, I think one thing that has come up across emerging markets globally is whether or not the power law actually applies to a lot of emerging markets at all. I think a lot of us have borrowed this aspect of power law from Silicon Valley, but when applied on emerging markets, it may not necessarily work. I don't know if your views have shifted slightly around that, or do you think MENA is kind of still evolving, or what are some of your thoughts? Because MENA is, as much as, there's a lot of emphasis on UAE and Saudi, and most of the deal flow comes from the UAE right now, the markets are still quite small. So in terms of exit probability and expectations, the likelihood of even a unicorn is actually really not that large. Like you look at Kareem, they're pretty remarkable exceptions
Yeah.
if you think about it. Don't know if you're gonna see a replication of that moving down the line, but maybe you think differently.
No, so that's what I was saying. Like my upper bound for exits is still at $1 billion. Like if I get the 40 X's are the ones that are $1 billion plus.
Mm,
So for me, I look at it not in terms of pure valuations. I look at it from is it a unicorn outcome for me as a fund? So if I'm generating 40x, then that is and kind of from the history that I have from the investments that I've done already, it kind of looks about right. I mean, my track record's a bit better than the numbers that I gave you, but generally those numbers tend to hold out when you're looking at multiples, not valuation. So I've done 30x on a deal that reached $100 million valuation. I mean, so it's not. that's where I'm telling you, like the pricing at entry makes a very big difference for emerging market investors as well. So you can't price the entry price the same way that you do in Silicon Valley because that definitely will not work, right? The
Mm.
power law will not hold if you are investing like a Silicon Valley deal, but the upper bound is not Silicon Valley upper bound. So that definitely won't work. But if you invest by taking into account all the regional factors and reasonable valuations for your region compared to where reasonable exit expectations are going to be, then kind of works.
Mm.
Um, so it depends. Like, I don't think we're gonna have so many unicorns. I think that a unicorn in the region is probably as rare as a decacorn or as $100 billion company in Silicon Valley. But you just have to adjust, and you'll still generate these kind of outlier returns. So for me, it's about can I generate these outlier returns, not what
Mm.
valuation does this deal get to.
The other question I have is also around TAM. Uh, has there been any kind of evolution around the way that you see or kind of uh, frame or define what TAM looks like? Not just for MENA, but and also in terms of your own pre-seed and seed investing philosophy, right? Are you seeing more founders who are targeting a larger TAM that's just beyond the region, and building really for the world, not so much for just MENA?
I don't know if you read my blog post. You probably haven't, but
I
like
saw a few.
I I think that time is bullshit. So like it's not a thing to look at a pre-seed and seed because it's always made up. You know that slide which has the three circles that are nested in each other. I don't even look at those numbers because they're meaningless. They're all just fluff, right? So TAM at where we invest at pre-seed and seed it's just like meaningless because it's just this imaginative number. It's some creative thinking. It's a made up number. So TAM for me is not something that I look at when it comes to pre-seed and seed stage startups in the MENA region for a variety of factors, other than the fact that they're made up and they're bullshit. Like the reality is that the best founders don't really know what the company's gonna look like and where it's gonna end up. But they're gonna get there and they're gonna find what that market is gonna look like, or they're gonna create what that market looks like. Some of my best companies that I've invested in, if you did it from a TAM philosophy, you're like, oh no, the TAM and all of the MENA region is $5 million. No way this company is gonna work. I was like, yeah, but it created the entire market, and now there's people copying, and they're using that TAM, their TAM as like their TAM slide. So it's like it's all of this doesn't is kind of meaningless in
Mm,
a nascent market like ours because markets are getting created, companies are disrupting and creating new markets. You don't really know how big something is gonna get because we don't really know. Things are still getting built here, right? So,
mm.
yeah, I think TAM is not something I care about.
So
And
if that's the case, then what really excites you as a pre-seed, investor? Is it the founder? What kind of founders do you look for? Are there specific opportunities that you think are still, something that we should be building something in? Yeah, what excites you these days?
I'd like, I want to work with founders that are just getting things done. They're not sitting pontificating or thinking or hoping they raise some money or whatever. They're just working and building something that they think the world needs, and the world does actually end up needing it. So, like, the thing that I like to look for is a bias towards execution. So, there's founders where we talk to them 1 month, we talk to them the next month. They haven't really done anything, but say, oh, we're waiting for this or we're waiting for that. There's other founders like, hey, we were waiting for this, but in the meanwhile, we did XYZ. And actually, look, this is probably more interesting than the first thing we were thinking about. So we're going to do more here. So, like, that, I guess, living, moving, breathing bias towards execution to just getting things done, that's kind of what I'm looking for. And that's what's worked well in terms of the investments that I've done in the past. So that's hard to quantify, but that's really the thing that I'm looking at. It's not the sector, it's not the TAM, it's not any of these things. In Silicon Valley, there's been a lot of things where like market is the most important. Markets here just aren't known, and you don't even know which these founders are going to end up in which market. So just back the right people, and it'll kind of work out. Um, it's a hard thing to quantify, and it's a hard thing to teach. So it's made me really strongly believe that venture capital is very much a bit like a cottage industry, and the way to learn it is through apprenticeship and by doing rather than being taught or anything like that. So, um, kind of my mindset right now. So there's no specific sector we're looking at. I don't like Me Too things where like there's five other players, we're gonna do another one, our price is gonna be better, so we'll win. No, that's all crap. I'm looking for things that are really different. I want founders where the first time you hear about them, you're like, "Oh, that's so weird," but then once you start thinking about it, you're like, "Wait, actually, no, that's a really great idea." So that's the kind of the thing that we're investing in. We're investing in the weird stuff, and the weird stuff is the ones that are overlooked. These are the outliers. These are the founders building something great. And usually, if you're following the crowd and you're following the herd into another BNPL company that looks like it's gonna be great, you might make a return, but you're not going to make an outlier return. To do the outlier returns, you have to just take a completely
I'm
different.
pretty sure some of them had a pretty good return from BNPL. Well, I hope they did. Like
Like
secondaries.
doing another one now, right? Like, come on, like the
Yeah.
opportunity is not another one, please. So that's my thesis. Not another one. Like another one of these guys. Another tuition marketplace, a tutor marketplace. No, thank you. I'm good. So, um, we're looking for weird and wonderful, different things that go against the grain with great founders that are going to build something and get things done. And so
Can
that's
you share maybe like an example of maybe one of your portfolio companies where maybe you saw and you were like, oh, that's so weird. And then as you really thought about it, perhaps you were like, oh, maybe there's something here that I'm missing.
that's most of them.
Really? I know it's difficult to choose between all of your,
Yeah,
usually
no,
they're
but
all
the
kind of
thing
your
is,
babies.
that, that's kind of what I'm like. The more it sounds like it's crazy, the more I get interested. It's like, oh, wait, let me just check and see whether this is really crazy or just sounds crazy, but it's actually really good. And so yeah, we've invested in weird and wonderful things. We've done everything from, we did Thunder that's just doing super well. They came into a market where in Egypt, you couldn't even open a brokerage account without like filling in tens of papers and forms and wet signatures and all this. To now, they're the number one brokerage in volume by volume in Egypt. They've disrupted the entire Egyptian stock market, and are leaders in their universe. So if you go into that, you're like, there's no opportunity. The Egyptian stock market, there's no, like, what are you talking about? It's such a small market. No one's going to be able to trade. And like all that sort of stuff. But they're great founders, like, and then they've done a really good job at executing, and now they're number one. And so that's kind of the thing we're looking at, and it's we've invested in Plus VC from anything from Lola, which is doing cake delivery. You should try it out if you're in
Cake delivery.
GCC. Yeah, you can customize your cake exactly to how you want, and it's delivered within a day, and it's great. And they're doing really well. Like cake, online cakes. And then we've done things like an underwater drone, which is used for inspecting oil pipelines and Mary Custis out of Tunisia. So we've it's a wide variety of things that we invest in, but what we hope that the commonality is that we've invested in great founders that are focused on execution, building
Yeah.
something that's kind of overlooked.
What do you think about this whole AI wave? You must see a lot of AI-enabled startups.
Uh,
And what does it mean for you, especially when it comes to DD, right? I mean, we've already seen, what is it, Builders AI, how that kind of unraveled before our eyes. I do think that the way that things are going in the AI space, we should be expecting a lot more
Yeah, there'll be a lot
horror
more volume
stories.
for sure. Yeah, but the thing is, so whenever there's a wave and hype, I kind of look the other direction. I was like, let the wave die down, let the hype die down, and then I'll look at the reality of the situation. So with AI, it was kind of the same thing. When ChatGPT came out, every startup deck that was crap just threw AI in there. I was like, this is bullshit. Like this isn't even AI. They just have ChatGPT as a front. Like they just have a it's just ChatGPT as a and it wasn't even like a core function in the business. It was just like a chatbot. I was like, what? And so there was a lot of fakes. A lot of people just threw AI into their deck and suddenly they were getting funding. But I avoided most of that and like my brain's function to avoid when there's too much hype around something because I've been through a bunch of these hype cycles now, so I kind of avoid that. But now that the hype is kind of, I feel it's kind of died down from a certain extent, and it died down when DeepSeek came out, where like, look, you don't need all these billions of dollars to build an AI business, and then we started to see real companies emerge, and so the way we're looking at AI now is AI is just table stakes, right? Every startup doing
Yep.
anything that they're doing is going to have AI somewhere in their tech stack. And for us, it's gone back to the same thesis is like, are they building something that's useful for the world? And can they acquire customers and users? And so it's just gone back to like the same way we look at things, but now they just have AI as part of their tech stack that allows them to do certain things. And as a result, we've ended up investing in a bunch of AI companies, but all solving very different problems, which weren't really that solvable before, mostly due to the available like the data stuff, right? So unstructured data was a big problem for a lot of different companies, and now with AI, you can kind of structure data a lot better and get things into a format that makes sense. So we've invested in a lot of companies that have AI within them and are utilizing AI to solve problems from all the way from prop tech, construction, uh, finance, a bunch of different things. And so, um, yeah, that's how we look at it. AI is table stakes. Are you actually using that technology to do something that wasn't doable before? And are there people willing to pay for that thing or not? And so that's kind of the way we look at it. So avoid the hype. Went back to just looking at the reality of the startup and just the way that like use AI the way you'd use a cloud based system like AWS.
Okay. Maybe last question around fundraising climate these days. Obviously, there's a bit of a downturn now. I think MENA is a little bit unique in the sense that you guys are mainly funded by the sovereign wealth funds, which everyone seems to be kind of sitting a little bit in trepidation on whether or not they're still going to continue investing in VCs. What's your sentiment around that and just general fundraising climate for GPs like yourself?
I think fundraising in the MENA region has kind of been difficult anyway. Unless you have like deep relationships with family offices, then you can probably raise a fund, but you hit the upper limit. Like you'd probably be able to raise a 20, $30 million fund, but getting to 100, $200 million fund in the region is quite difficult. And if you want to avoid the pitfalls of the strings that are attached with some of these funds, which we do, we don't like to take money with strings attached to it. We're like, I'll give you $1, you have to invest $1 in this market or in this sector. For us, again, back to the original thesis that I want to invest in the best deals in the region no matter what. So I don't want those sort of handcuffs attached to it, even if it'll help me with fundraising. So if you don't take that money, it's even harder for you to raise. So although there is a lot of funding that's out there in family offices for other asset class or VC, it's still not a thing. A lot of family offices are like, well, I can just do this myself. I don't need you to do it. The deals will come to me. I was like, yeah, you probably see 10 deals a year. We see 3,000. Maybe a little bit of a difference in access to deal flow, but yeah, it's okay. Let's be in touch once you print your fingers a little bit and see what happens. So it's hard to raise from families, and again, it's very relationship driven. Um, but we're starting to see more and more acceptance of actually this is an asset class we need to have some allocation to, so it's becoming a bit better on that front. In terms of the sovereign funds, honestly, what they've been investing in VC is a pittance. It's nothing. Across the region, if the total amount of funding in the region last year was like less than $2 billion, like that's
But you're saying this like vis-a-vis all of the allocations that they have made globally, right?
Yeah, it's not
Yeah.
in general. Like when you look at the whole MENA region, 16 countries, is $2 billion. Like that's like unknown markets in Europe already have $2 billion being
Well,
invested.
then the question is whether or not they're still committed to reinvesting in their local ecosystems because historically they've always, brought in or invested in global GPs. But
Yeah,
I mean, looking like the
I think
BlackRocks and the Blackstones of the world,
that's
right?
not going to change. The majority of funding is going to continue to go outside the region. That's just the reality of where we are in the MENA region. But when it comes to the region, I'm just happy that they are providing some capital to the region. A lot of the funds have ignored the region completely, and as a result, there was no funding coming into these markets. And then the other thing is, a lot of the funds are so big that their minimum requirements like, oh, we need to invest in at least a $500 million fund. I was like, you can't deploy $500 million in our ecosystem right now because their
Yeah.
check size is like 50 million or 100 million. So we started to see more of the institutional investors come down to deploy smaller checks, 10 and $20 million checks, which allows them to really access the market. So I think the universe of LPs has improved, but it's difficult. There's not a lot of LPs that are actively deploying into VC in the MENA region. And so that's just the reality of the situation. There's a few hands out there. There's a few relationships you might be able to get some money from, but
Mhm.
any of the funds that are trying to raise more than $100 million fund in the region actually have to go look for sources of capital outside the region.
So what does it mean in terms of fundraising strategy for, say, I mean, you're not fundraising right now, are you?
Uh, I mean, we closed Fund One. We've been deploying. We're 85 deals in that fund, so we're pretty happy for now. But we'll start working on Fund Two quite soon. So yeah, building those relationships outside the region is something that's important as well.
Mhm.
In addition to that, yeah, just continuing to see new sources of capital, new pools, new investors that you can kind of convince to take a shot and believe in it.
Okay, cool. All right, I think we've come to the end of the podcast. Thank you so much, Hasan, for joining me
Great.
today.
Thank you for
Uh,
having me.
yeah, I hope to see you again soon.